Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. During today's show, we're going to address IRA inheritance strategies and some of the common mistakes you should work to avoid. Let's jump right into this important topic with an article from Kiplinger, Inherited an IRA. Avoid these common mistakes that can cost you, which I think does a good job of clearly spelling out some key facts and figures. Inherited IRAs are also often called beneficiary IRAs because that's just what it's called when an IRA gets passed along to a spouse, a family member, or someone else you care about after you've passed away. Now here's the thing, you can actually leave an IRA to just about anyone. But the rules for what happens next can be very different depending on who that beneficiary is. Once that transfer happens, the money from the original IRA moves into an inherited IRA in the beneficiary's name. You can't add new money to it, but it does stay tax deferred, which may be a good thing. But here's where it can get a little tricky, especially if you're not the spouse. In that case, the IRS says you have to fully withdraw that inherited IRA within 10 years of the original account holder's death, and every dollar you take out counts as ordinary income. So if you wait until year 10 to do something about it, well, let's just say you could be staring at one very big, very unpleasant tax bill. And that's exactly why planning ahead with someone who knows the rules inside and out can make all the difference. Now, if you've been listening for a while, you know I like to keep you up to speed on the rule changes that can have a big impact on your retirement plans. One of the biggest shifts in recent years came with the Secure Act, or the Setting Every Community Up for Retirement Enhancement Act of 2019. Here's what it means for inherited IRAs. If you're not the spouse and you inherited that IRA after December 31st, 2019, you're now looking at what's called the 10-year rule. That means you have to fully withdraw the account within 10 years. But there are a few important exceptions, and this is where working with a financial services professional can really help. If you're within 10 years of the original account holder's age, if you're disabled or chronically ill, or if you're a minor child of the deceased, you're allowed to follow the old rules. In other words, you can stretch those withdrawals over your lifetime. And if the person you inherited from had already started their required minimum distributions, or RMDs, which now begin at age 73, you'll have to continue taking those during your 10-year window based on your own life expectancy. Now here's something to remember. You can leave an IRA to anyone, but the tax rules definitely favor the spouse. Spouses get the most flexibility. In fact, they're the only ones who can simply treat that IRA as their own. And if you inherit from your spouse, you've got several smart options, and choosing the right one for you can make a huge difference in your taxes and your future income. All right, let's get into the options, because if you inherit an IRA from your spouse, you actually have a few different paths you can take, and choosing the right one for your situation really depends on your age, your income needs, and your long-term plans. The first option is what's called a spousal transfer. This simply means you take over the account and become the new account holder. The money is yours, and it's accessible right away. But remember, any withdrawals you take will still be taxable. If you're under 59 and a half, there could also be penalties, unless you qualify for one of the IRS exceptions. Here's the good news. Your RMDs will now be based on your age, not your spouse's. If you're younger, that means you can stretch those withdrawals over more years, potentially easing the tax bite. Option 2 is to open an inherited IRA. In this case, you roll the assets into an inherited IRA in your name. RMDs will still be based on your life expectancy, but you'll also need to fully withdraw the account within 10 years. This route can make sense if you're under 59 and a half, and you know you'll need access to the money sooner rather than later. And then there's the third option, which is taking a lump sum. You can cash the whole thing out right away, but keep in mind that money is treated as ordinary income. A big payout like that could push you into a higher tax bracket, and that means more taxes owed. The article next analyzes rules for non-spouses who inherit an IRA. Now, if you're inheriting an IRA and you're not the spouse and you don't fall into one of those exceptions we talked about earlier, your choices are a little more limited. The first option is to open what's called an inherited IRA. Here's how that works. The assets get moved into an account in your name, your required minimum distributions are calculated based on your life expectancy, and you've got that 10-year clock ticking. That money still grows tax deferred while it's in there, so you're not paying taxes on the earnings each year. The second option is to cash it all out in a lump sum. And while that might sound tempting, here's the catch. Every dollar you take out is treated as ordinary income. Depending on the size of that account, this could easily push you into a higher tax bracket, which means a bigger check to the IRS. All right, let's shift gears and talk about what happens if you inherit a Roth IRA, because while a lot of the same rules apply, there's also a pretty big upside. Here's the headline. With a Roth IRA, you don't owe taxes on withdrawals. That's because Roths are funded with after-tax dollars, and the account grows tax-free. For many beneficiaries, that's a huge advantage. Now, there are a couple of caveats if you want to keep those withdrawals tax-free. First, the original Roth IRA has to have been open and funded for at least 5 years. Second, if part of the Roth came from a conversion, say from a traditional IRA, those converted balances must sit in the account for at least 5 years before they can be withdrawn without penalty. And while the original account owner never had to worry about RMDs, you do have one requirement as a non-spouse. You have to make sure the account is emptied within 10 years of the original owner's passing. It's not the same as taking an RMD each year, but that 10-year clock is still ticking. If you're inheriting the Roth IRA from a spouse, though, you've got even more flexibility. You can treat it as your own and spread withdrawals over your lifetime, or even leave it alone and let that money keep growing tax-free for as long as possible. One potentially smart move you can make with an inherited IRA is to think about timing. Spreading your withdrawals over several years can often be a way to reduce the tax bite. In fact, many financial services professionals see this as one of the most effective strategies for keeping more of your inheritance in your pocket and out of Uncle Sam's. And here's the beauty of it. With an inherited IRA, you've got flexibility. You can take a little more in a year when you need it and pull back in years when you don't without facing an early withdrawal penalty. That flexibility can be a real gift if you know how to use it strategically. In many cases, financial services professionals also recommend to their clients that they steer clear of cashing out the whole thing in a lump sum. Sure, it might feel simpler, but the tax bill can be brutal and often unnecessary. There's another important piece of advice here. Don't let loyalty to the past keep you from making smart moves for your future. The investments in that IRA may have been perfect for your loved one, but they might not be right for you. Your goals, your risk tolerance, and your timeline could be completely different. So don't think of it as dad's IRA or mom's portfolio. Think of it as your tool for building the next stage of your financial life. If you have any questions about the new generation retirement system, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.